How is capital gains tax calculated when selling a condo? Have you ever wondered how capital gains tax is calculated when selling a condominium? Understanding this can help you make informed decisions in real estate investing. Let's break it down step by step. First, you need to determine the type of capital gain. If you own the condo for 1 year or less, your gain is considered short-term. This means it will be taxed at your ordinary income tax rate, which can be as high as 37%. If you own the condo for more than 1 year, it is classified as long-term. Long-term gains are taxed at low rates, typically 0%, 15%, or 20%, depending on your income. Next, calculate your gain. Start with the original purchase price of the condo. Then, note the selling price. To find your net gain, subtract the purchase price from the selling price. If you made any improvements or renovations, you can add those costs to your original purchase price. This adjustment increases your basis, which can lower your taxable gain. Now, let's talk about exclusions. If the condo was your primary residence for at least 2 of the 5 years before the sale, you might qualify for a primary residence exclusion. For single filers, you can exclude up to $250,000 of the gain from capital gains tax. If you are married and filing jointly, the exclusion can be as much as $500,000. After determining your gain and possible exclusions, you will need to find out your tax rate. If your gain exceeds the exclusion amount, you will pay long-term capital gains tax on the excess. Your tax rate will depend on your taxable income and filing status. For example, in 2025, if you are married and filing jointly, the 0% rate applies if your taxable income is below $96,700. The 15% rate applies for incomes between this threshold and $600,051. If your income exceeds this amount, the rate is 20%. Additionally, keep in mind that if your income is high enough, you may also owe a 3.8% net investment income tax on your net investment income, which includes capital gains. For real estate investors, it is wise to hold properties for more than 1 year to qualify for those lower long-term capital gains rates. Also, keeping detailed records of any improvements made can help reduce your taxable gains. If you are selling a condo that was not your primary residence, be aware that you will not qualify for the primary residence exclusion, meaning all gains will be subject to capital gains tax. Understanding how capital gains tax is calculated when selling a condominium can help you strategize your home selling processes effectively. By being informed, you can make smarter decisions in your real estate investments.